Welcome to the ProTaker Deep Dive.
It's great to be here.
Today is Monday, February 9th, 2026. And I have to be honest with you, looking at the terminal this morning, looking at the sheer volume of data hitting the wires, it feels like the market is suffering from a split personality.
It's a schizophrenic Monday. You're absolutely right. It's like one part of the market is sprinting a marathon and the other part is just staring over a cliff.
Staring over a cliff, that's a good way to put it. We aren't seeing a single coherent narrative today. We are seeing these massive tectonic shifts that seem to be completely contradicting each other.
Totally.
On one side of the screen, you have tech optimism pushing stocks to the moon. On the other side, actual moon missions are being rescheduled.
And you have legal vindication sending one stock into the stratosphere while crypto is staring into an abyss. It is one of those days where if you just look at the S&P 500 top-line number, you are missing the entire story.
You're just seeing the calm surface of the water.
Exactly. You're missing the friction, the sharks, the currents underneath, everything.
The friction is the point, and that is why we are here. We need to unpack the why behind these moves. And the biggest story on my desk today, the one that actually made me put my coffee down and stare at the screen, is the situation over at Boeing.
The aerospace giant. It's always, well, it's never a dull moment with them, is it?
Never. But this is specific. Here is the central tension we are going to explore today, and I want you to really keep this in mind. What happens when the people running the company, the people inside the building, the ones looking at the blueprints and the bolt tightness, are selling stock? But the people on Wall Street, the ones looking at spreadsheets in Manhattan, are screaming, buy.
It's the classic inside versus outside dilemma. It's the asymmetry of information. And with Boeing, right now, that divergence is wider than I've seen in a very long time.
Yeah.
It's a chasm.
We're talking about executives, top brass, cashing out millions of dollars just days ago. And yet, the analysts are predicting a massive rally. So who is right? That's the main event.
It's a fantastic setup.
But we also have a secondary story that is honestly just wild. Applovin.
Oh, the Applovin chart is a sight to behold today. Up roughly 15% in a single session. It looks like a rocket launch.
And it's not because they invented a new microchip. It's not because they acquired a competitor. It's because a money laundering claim just vanished.
Poof, gone. And we're going to talk about what that means, how a cloud of suspicion can destroy value, and how quickly fortunes change literally overnight when that cloud is legally lifted.
It's a masterclass in market psychology.
It really is. It's all about the reputation discount.
And if we have time, and we will make time because this is important, we have a lightning round that is just packed. SpaceX changing its planetary targets. Sorry, Marzana. Hello, Moon.
A very pragmatic shift.
Ethereum facing what the charts are calling a death zone. And some very mixed, very telling signals coming out of the auto industry with GM and Li Auto.
It's a full docket, a lot to unpack there.
It is. But our mission statement for today remains the same. We aren't just reading the ticker tape. We are trying to understand signal versus noise. When an insider sells, is it a warning sign or is it just a bonus check?
Right.
Does a retraction of a claim make a company a safe bet?
That's the billion-dollar question. Let's dig in.
Okay, let's unpack this. Segment 1, the Boeing paradox. I want to start with the headline numbers because they are fresh. They just hit the wires from the SEC filings regarding transactions on February 5th.
Okay, lay the numbers on me.
So, looking at the Form 4 filings, Boeing insiders, and I don't mean mid-level managers, I mean the C-suite level or very close to it, have sold over $3 million in stock.
3 million. That's a heavy number. I mean, in the grand scheme of Boeing's market cap, it's a drop in the bucket.
Sure.
But in the scheme of personal wealth and the signal it sends, that's massive. Who are the sellers?
We have names. Howard E. McKenzie, he is the chief engineer.
Stop there for a second. The chief engineer, let's just let that sink in.
Right.
In an engineering firm, specifically an aerospace firm that has been, let's say, plagued by engineering questions for the last 3 years, that title carries more weight than the CEO in some respects. This is the guy ultimately responsible for the technical integrity of the product.
I agree completely. He sold approximately 10,496 shares on February 5th. I ran the math on the closing prices. That transaction value was roughly $2.46 million.
Wow.
$2.5 million gone from his portfolio, converted into cash.
That is a significant liquidity event for anyone. That's not just paying a tax bill. That's a life-changing amount of money.
And he wasn't alone. On the same day, Uma M. Nuluru, the EVP and Chief Human Resources Officer, sold around 2,731 shares. That's another $645,000. So combined, just those two, We're crossing the $3 million mark in a single day.
Okay, so let's pause there because I can hear the listener asking the obvious question, and frankly, I'm asking it too.
Go for it.
If the chief engineer of the company that builds the planes is selling $2.5 million worth of stock, does that mean he doesn't believe in the planes? Is he seeing something on the factory floor that Wall Street can't?
That is exactly where my mind goes.
Yeah.
It feels like a massive vote of no confidence. It feels like he knows something we don't. It's the ultimate information asymmetry.
It feels that way, yes. The optics are, let's just say, suboptimal. They're terrible. But we have to play the devil's advocate here. We have to look at this dispassionately. We have to look at the stock performance context.
Fair enough. The stock has been doing well recently, right?
Yeah.
After a pretty brutal stretch.
Well is an understatement. Boeing stock has rallied roughly 35% over the past year.
35%. Okay. That changes the framing a bit. It's not like he's selling into a panic.
It changes it entirely. He's selling into strength. So, because yourself in Howard McKenzie's shoes for a second, you've been working through a year of intense regulatory scrutiny, safety audits, what the media calls production hell.
An absolute nightmare, I imagine.
The stock was beaten down. Now, finally, it has climbed back up. It's up 35%. You have a huge chunk of your net worth, maybe the majority of it, tied up in these shares that were underwater a year ago.
Right. All your eggs are in one very scrutinized basket.
Is it panic selling? Or is it simply, hey, the stock is high, I want to buy a vacation home, or I need to pay a massive tax bill on my vested shares, or more likely, I just want to diversify because I'm overexposed to one company.
So you're saying this could just be routine portfolio management, taking some chips off the table after a winning streak. It's the sensible financial planner thing to do.
Precisely. We have to remember how these executives are paid. They are paid in restricted stock units, or RSUs, or options. Selling stock is often the only way they actually get paid the cash value of that work. So selling after a 35% rally is often viewed by the market as a rational liquidity decision rather than a strategic get-out-now signal.
I get that. I do. But it's the timing that gnaws at me. You mentioned safety and regulatory scrutiny. We all know what Boeing have been through in 2024 and 2025. The door plugs, the whistleblowers.
This has been a trial by fire.
They are currently ramping up production. They are trying to prove to the world, to the FAA, to their customers, that they are back on track.
Correct. They are in the show-me phase of the recovery. Every single plane that rolls off the line is under a microscope.
So when the chief engineer, the guy responsible for the technical integrity of the product, sells right now,
Yeah.
even if it is for a vacation home, doesn't it look shaky? Doesn't he know how that looks?
Oh, he absolutely knows how it looks. His PR team, his legal team, they all know how it looks, and that's why we are talking about it.
Right.
If this were a software company and the CTO sold some shares, nobody would blink. But this is Boeing. Every bolt matters. Every rivet is a story. And every share sold by the engineering lead is going to be scrutinized under a microscope.
And it's not just these two, is it? Looking at the broader data from the last quarter, this isn't an isolated event.
No, it's not just them. That's a key point. If we zoom out and look at the last 3 months, corporate insiders at Boeing have sold a total of $3.3 million worth of stock. It's a trend.
It's a pattern.
It's a pattern. It's not a one-off. A single sale can be explained away. A pattern of sales from multiple executives.
Right.
That's harder to ignore.
And I'm looking at the sentiment signal here. Market data indicates the insider confidence signal for Boeing is currently marked as negative.
That's a proprietary signal, but it's based on a really important concept: informative transactions.
Explain that term for the listener. What is an informative transaction versus just a sale?
Good catch. So, not all insider selling is the same. Sometimes an insider sells because of a pre-scheduled plan called a 10b5-1 plan.
Right. They set that up months in advance.
Exactly. They decide 6 months ago, I will sell 1,000 shares on Feb 5th, regardless of the price. That is considered uninformative. It doesn't tell us what they think today. But informative transactions are discretionary. They are deciding now to sell. And the data suggests that's what we're seeing, a pattern of informative discretionary selling.
I'm looking at the chart of these transactions right now. It's fascinating visually. You have the price line, this orange line, climbing steadily up, recovering. And then underneath it, you have these bars representing insider trades. And recently, it's all red bars, informative sells.
It's a classic divergence. Price goes up, insiders sell. Usually in a healthy, confident rally, you want to see insiders buying into the rally, confirming it, or at least holding.
Putting their money where their mouth is.
But here, they are selling into the strength. They are using the liquidity provided by retail and institutional investors to exit their positions. It's like they're the ones serving the drinks at the party, but they aren't drinking themselves.
Okay, so that's the inside view. The people in the C-suite are cashing out. Now let's pivot to the outside view. Because if I just told you that insiders are selling, you'd assume Wall Street is screaming sell right alongside them.
You would assume that. It's the logical conclusion, and you would be completely, utterly wrong.
It's the exact opposite. It's bizarro world.
It is. The analyst consensus on Boeing right now is a strong buy.
Strong buy, not just a buy, not a hold, a strong buy.
Let's break down the ratings because the numbers are stark. In the last 3 months, there have been 16 analyst ratings issued for Boeing.
Okay, it's decent sample size.
A very good sample size. Of those 16, 14 of them are buys.
14.
One is a hold, and only one is a sell. 14 out of 16 professionals whose entire job it is to analyze the company's future cash flows say, buy this stock.
That is overwhelming bullishness. That is a landslide. It's not even a debate among the analysts.
It's not. And look at the price targets. The current average price target is sitting at $269.14.
And the stock is trading around, what, $243 right now?
Right. So that implies an upside potential of about 10.74%. The pros are telling you there's still a double-digit gain to be had from here. And the high forecast. One analyst thinks this stock is going to be at $298.
$298. That's nearly a 20% jump from here. That's a massive return for a blue chip industrial.
Exactly. Though, to be fair, the low forecast is $150. So there is one bear in the woods who thinks it's going to crash. But the consensus, the overwhelming weight of opinion is incredibly positive.
Let's talk about credibility here, because sometimes analysts just follow the herd. Who are these people? Are they top tier?
These are heavy hitters. We have Sheila Kahyaoglu from Jefferies. On February 5th, the very same day the insiders were selling, mind you, she reiterated her buy rating with a $295 target.
You can't make this up. So literally while the chief engineer is hitting the sell button, Sheila at Jefferies is on the phone with clients hitting the buy button with a $295 target.
The irony is palpable. It's a perfect snapshot of this whole paradox. Then you have John Godin at Citi. He also reiterated on February 5th his target, $290. And Ronald Epstein at Bank of America, a very respected name in aerospace coverage, he reiterated on February 3rd with a $270 target.
So these aren't outdated ratings from 6 months ago. These are fresh. These came out this week.
Correct. They are looking at the same company, the same production schedules, the same regulatory environment, the same everything, and coming to the polar opposite conclusion of the insider's action.
So here's where it gets really interesting. How do we reconcile this? Why is the view from the skyscraper in Manhattan so different from the view from the corner office in Seattle or Arlington?
It comes down to time horizons and metrics. The analysts, people like Sheila and John, they are building these complex financial models based on future cash flow. They are looking at the order book.
A backlog, which for Boeing is just immense.
The backlog is massive. It's years long. They are seeing that airlines are desperate for planes. They are seeing that Boeing is essentially a duopoly with Airbus. Airbus is sold out until the 2030s for some models. If you want a new plane in the next 5 years, you have to buy Boeing.
They have a captive audience.
I do. The analysts are betting that the production problems will be solved. It's an engineering problem, not a physics problem. And when they are, the cash will flow like a river. They're modeling a return to normal.
They are betting on the machine getting fixed. They are betting on the inevitability of the demand. They see the problems as transient, but the duopoly as permanent.
Yes. They are looking at 2027, 2028. They are pricing in the recovery. They are modeling what they call normalized free cash flow. What will this company earn when it's running smoothly again?
And the insiders, what are they looking at?
The insiders are living in the now. They are looking at their personal bank accounts. They're looking at the daily production reports. They're saying, I have millions of dollars concentrated in one stock. That stock just went up 35%. I don't know if a door plug is going to blow out tomorrow. I don't know if a strike is coming next week. I'm taking the cash.
So the insider selling is about personal risk management, whereas the analyst rating is about corporate potential.
Exactly. An insider selling doesn't necessarily mean the company is doomed. It just means the insider prefers cash to stock at this specific price point for their own personal reasons. But, and this is the big but, as an investor, you have to decide which signal carries more weight for you.
That is the friction point. We have a negative insider score from the data and a strong buy analyst score. It's a tug of war.
And usually in that tug of war, the insider knows more about the immediate operational risks. They know if the supply chain is snarled. They know if the FAA is angry. They know the mood on the factory floor.
The ground truth.
But the market mechanism, the collective wisdom of the analysts, is often better at pricing the long-term value and the macro environment. They're less emotional about a single bad quarter.
It's fascinating. It really forces you to choose your timeline. If you're a day trader, maybe you follow the insider. If you're holding for 5 years, maybe you follow the
Or
analysts.
maybe you just sit on the sidelines and watch until the signals align. That's a valid strategy, too. You don't have to swing at every pitch.
True. Very true. Speaking of signals aligning, or rather, signals completely flipping, we need to talk about our second segment, the resurrection of Aploven.
Ah, APP. What a chart today. It's almost a vertical line.
For those not watching the ticker, Aploven stock is up 15% today. At one point, it was up 14.69% exactly. But it's hovering around that massive 15% gain. This is a multi-billion-dollar move in market cap.
It's huge. It's a violent move to the upside, the kind of move that creates fortunes and liquidates short sellers.
And the catalyst is, well, it's like a legal thriller. It's not an earnings beat.
It really is. We have to go back a bit to understand the jump. Aploven had been dogged-hounded, really by some very serious allegations. A financial publisher had come out and claimed that this mobile tech company was engaged in illegal activities.
And not just cooking the books illegal. We are talking money laundering illegal. The most serious charge you can level at a financial entity.
That is the nuclear option of accusations. When you accuse a company of money laundering, you are essentially saying the business model is a crime. You aren't saying margins are weak. You are saying this company shouldn't exist. It's an existential threat.
Right. And that scares everyone away. Institutional investors can't touch it because of ESG rules and compliance mandates.
Compliance departments shut it down immediately. The stock gets a massive reputational discount. It's like a scarlet letter.
Explain that concept, reputational discount.
It means investors price in the worst-case scenario. They price in massive fines from the Department of Justice. They price in the possibility of being delisted from the stock exchange. They price in executives going to jail. The stock trades as if it is guilty until proven innocent. The valuation gets compressed because the perceived risk is off the charts.
So the stock is suppressed. It's holding this heavy weight. It's like running a marathon with a backpack full of rocks. And then, today happens.
February 9th, 2026. The financial publisher who made these claims formally withdraws them.
They didn't just stop talking about it. They didn't just go quiet. They issued a formal retraction. They withdrew the claim.
They said, never mind. And instantly, that weight is gone. All those worst-case scenarios are wiped off the table.
It's like cutting the straps in that backpack. The runner can suddenly sprint.
That's the perfect analogy. This 15% jump we are seeing today. It's not because Aploven's business got 15% better overnight. They didn't sign a new customer. They didn't release a new ad tech platform. Their revenue projections for next quarter didn't change at all.
It's a relief rally, pure and simple.
It's the risk of ruin evaporating. Yesterday, there was a non-zero chance this company could be regulated out of existence. Today, that chance is effectively zero, or at least back to normal business risk levels. The discount rate investors applied to the stock just dropped, so the price mathematically has to rise to reflect that new, lower risk.
It's like a defendant in a court case hearing the judge say, charges dismissed. You walk out of the courthouse and the sun shines a little brighter, your future is restored.
And the market loves a redemption story, especially in the age of algorithmic trading. As soon as that headline hits the newswire, claims withdrawn, the algorithms read it.
Before a human can even process it.
They process the sentiment change, they see legal risks removed, and they buy instantly. Before a human trader can even sip their coffee, the stock is up 5%. Then the short sellers start covering, the momentum traders jump in, the FOMO sets in, and it goes to 15%.
I was looking at the Aploven logo while reading the report. You know that triangle node network thing?
Yes, representing connectivity, the ad network graph.
It felt so ironic looking at that symbol of connection while they were accused of these dark, illicit connections. And now, today, that logo looks clean again. It represents something positive again.
It's a reminder of how fragile corporate reputation is. A single report, a single accusation can destroy billions in value in a day, and a retraction can restore it in a day. But also, it shows how resilient price can be when the truth, or at least the legal truth, comes out.
So the takeaway here for you, for the listener.
The legal vindication is one of the most powerful catalysts for short-term price action you will ever find. If you are watching a stock that is beaten down by a lawsuit or an allegation, and you do your own research and think there's a chance they beat it, that is where the alpha is. That is where the asymmetrical return lives.
But it's incredibly risky.
Oh, it's high risk. If the claims had been proven true, That stock doesn't just fall 15%, it could go to zero.
High risk, high reward, just how we like it.
Okay.
All right, let's zoom out. We've looked at the specific drama of Boeing and AppLovin. Now I want to hit the lightning round. We're calling this the ticker tape analysis. I'm going to throw a headline at you from today's feed, Feb 9, 2026, and you tell me what it really means.
I'm ready to connect the dots. Let's do it.
Okay, first up, space and tech. We have an update from SpaceX. They are pushing back the Mars landing.
Again, no surprise there.
Again. But they are refocusing specifically on a 2027 moonshot.
This is significant. This is more important than the Mars delay.
Why? Isn't delaying Mars a failure? Musk has been promising Mars for a decade. The dream is getting further away.
It's not a failure, it's a maturation. It is a pivot from being a missionary to being a mercenary. For years, Elon Musk and SpaceX have sold the Vision Mars, multiplanetary species, the sci-fi stuff that gets headlines.
Gee.
But the business is government contracts. The business is Artemis. The business is putting boots on the moon for NASA and getting paid billions to do it.
So shifting to the moon is shifting to the money.
It's shifting from visionary sci-fi to deliverable contracts. 2027 is next year. This is them saying, we need a win, we need a successful landing, we need to cash the check, let's go for the target we can actually hit. It's a very pragmatic signal for the space economy.
So less sizzle, more steak.
Precisely. It means the space economy is becoming a real economy, not just a dream funded by venture capital.
Interesting. Okay, staying in tech. Microsoft. MSFT stock is on the rise. Reports are emerging today that the next Xbox isn't just a console, it's a gaming hybrid.
This aligns with everything we're seeing. The wall between hardware and software is dissolving. Microsoft doesn't just want a box under your TV anymore. They realize the old console wars are over.
And it won.
The cloud won. The ecosystem won. They want a device that bridges the cloud, the handheld, and the living room. It's an ecosystem play. They want to be the Netflix of gaming with Game Pass, but they also want to sell you the dedicated device to run it on optimally.
So it's both a hardware and a software play.
It's defensive against Apple's ecosystem and offensive against Sony's hardware-first approach. It's a smart move.
Okay, let's talk chips. The chip wars. AMD. The headline is, AMD stock has strong potential in 2026, despite an early setback.
The semiconductor cycle is it's relentless. AMD had a stumble early in the year, maybe a product delay or a slight miss in benchmarks against NVIDIA's latest Blackwell chips. But the expert analysis here is clear. The demand curve for compute is still vertical.
Is this all AI-driven? Or is there more to it?
It's almost entirely AI-driven. The hunger for compute power is so vast. We are talking about training clusters that cost billions of dollars for a single model, that even the second-place player or the alternative to NVIDIA is going to have massive, massive potential.
So the pie is so big, everyone gets a feast.
The market is saying, we forgive the setback because we need the chips. We need them from anyone who can make them. We can't wait. The demand is insatiable.
So buy the dip on the chip makers.
The macro trend says yes. The cycle is still hot. We are nowhere near the peak of AI infrastructure build-out.
Now let's switch to something a little colder. A lot colder, actually. Crypto.
Oh, boy. Yeah, winter is here.
The headline is terrifying. Can Ethereum survive the $2,000 death zone?
Death zone. They love that dramatic language in crypto, don't they? Sounds like something out of Everest.
What does that actually mean? Is it just a price point?
Yeah.
Or is there something more technical?
It's a psychological and technical floor. So in technical analysis, you have support levels where buyers tend to step in. For Ethereum, $2,000 is a massive psychological anchor. It's a round number. People feel safe above it. More importantly, institutions have likely set their automated stop losses just below it.
And if it breaks?
If it breaks, the algorithms trigger sell, the stop losses hit all at once, the margin calls happen, we call it a liquidation cascade. The death zone just means a zone of high volatility where the asset could free fall to the next major support level, which might be, $1,500 or even lower. It's an air pocket.
Such a stark contrast. We have Boeing and AppLovin rallying, stocks hitting highs, and crypto is teetering on a ledge.
It shows that risk-on sentiment isn't universal. It's fractured. The stock market is partying because of earnings and AI growth. The crypto market is sweating because of regulatory fears and ETF outflows. They are usually correlated, but right now they are decoupling. And that is very dangerous for crypto traders who assume the tide lifts all boats.
Last one for the lightning round. Automotive. We have a tale of two cities here. First, General Motors. Canadian politicians are calling for tax relief on GM's severance packages.
Ouch. When you hear severance packages and tax relief in the same sentence, that implies one thing: layoffs. And not a small number.
Big time.
This is the old guard of auto. GM is still wrestling with legacy costs, powerful labor unions, and a massive restructuring to go electric. They are trying to lean out the organization in Canada to compete with the leaner EV startups. It's a defensive crouch. They are cutting muscle to save the bone.
And then we have the new guard, Light Auto. Stock falls as JP Morgan downgrades it.
So GM is dealing with labor, and Lai is dealing with valuation. It's the perfect contrast. The new EV players, the Chinese startups, they flew high on hype and growth promises. Now, the big banks like JP Morgan are coming in with the reality check.
The party's over.
They're saying, show me the profit, show me the sustained growth, the hype phase is over, now you have to execute. It's a valuation haircut.
So old auto is cutting costs to survive, and new auto is getting its valuation cut back down to earth.
It's a tough sector right now. If I had to choose between aerospace and auto today, based on this news, I think I'd take the turbulence at Boeing over the structural issues in auto. At least Boeing has a multi-year backlog.
Wow, that says a lot. To choose Boeing's drama over that?
It does. It tells you how difficult the auto transition is proving to be.
So what does this all mean? We've covered a lot of ground in this deep dive. We have Boeing executives selling into a rally. We have AppLovin clearing its name and popping 15%. We have SpaceX pivoting to the moon for the contracts. We have Ethereum looking into the abyss.
If I had to synthesize this day, February 9th, 2026, into a single theme, it would be correction and clarity.
Say more about that. That's interesting.
Think about it. In every story, something is being corrected to find a clearer picture of reality. Boeing insiders are correcting their portfolios, rebalancing after a rally, acknowledging the real present risk. They're bringing their personal balance sheets back to a clearer, safer state.
Okay.
AppLovin is correcting the public record, wiping away a false claim to reveal the true underlying value of the business. That's a massive clarification.
And SpaceX.
SpaceX is correcting its timeline and its priorities, moving from the fantasy of Mars to the reality of a lunar contract. They are clarifying their business model. Even Ethereum is facing a moment of clarity. Is $2,000 the real floor, or is the real value lower all along?
So the market is constantly seeking the true price, the true narrative.
Exactly. We are wading through noise money laundering claims, insider filings, Mars dreams to find the signal. The signal is the true value of the asset. And today, the market did a lot of work, violently in some cases, to find that truth.
It's a messy process, but it works.
It works eventually. It's not always pretty.
I want to leave the listener with a final thought, something to chew on while they drive home or sit at their desk.
Here is what I am thinking about. We started with Boeing. We saw the divergence, strong buy from the analyst, a clear sell action from the chief engineer.
Right. The core paradox of the day.
So I ask you, the listener, when you are putting your hard-earned money into a company, who do you trust more? Do you trust the person looking at the spreadsheets, modeling the future cash flow 5 years out, assuming the world will work as planned? That's the analyst. They see the potential. They see the forest. Or do you trust the person looking at the blueprints? The person who walks the factory floor, who knows which bolt is loose, which software patch is buggy, and exactly how much stress the system can take before it breaks? That's the engineer. They see the reality. They see the individual trees.
Spreadsheet versus blueprint.
Today, the spreadsheet says buy. The blueprint says sell. History will tell us who was right. And your answer to that question probably tells you a lot about what kind of investor you are.
Man, that is going to keep me up tonight.
It should. It's the central question.
Thank you all for listening. Stay curious, stay skeptical, and we will see you on the next deep dive.